In my previous video, we discussed rules and questions based on interest on capital, and today we will discuss about partners' capital account. Let's begin. First of all, the question arises why there is a need to prepare partners' capital account. So the purpose of making partners' capital account is to find out closing balance of partners' capital account. The partners' capital account changes because of various adjustments made during the year. And this is required that at the end of the financial year, the closing balance be calculated so that the balance sheet can be prepared. Now, there are two methods under which the partners' capital accounts are maintained. The first one is fixed capital account method, and the second one is fluctuating capital account method. Let's find the difference between the two methods. First of all, the fixed capital method. Under this, the capitals of the partners remain same except when there is permanent nature of addition or withdrawal. And in case of fluctuating capital account method, the capitals of the partners keeps on changing on regular basis. In the fixed capital account method, there are two accounts which are being maintained. These are named as current capital account and capital account. Whereas in case of fluctuating capital account, only one account is maintained, that is named as capital account. Now, the capital account under the fixed capital account method shows only the credit balance, whereas the capital account under the fluctuating capital method may show either debit or credit balance. Now, the reason behind the same is the adjustments like interest on capital, interest on drawings, commission, salary are shown in the current capital account and not in the capital account as per the fixed capital account method. Now, under the fluctuating capital account method, the adjustments are shown in the capital account. These adjustments are interest on capital, interest on drawings, commission, salary. So these are being shown on the capital account. Let's discuss once again that the capital account under the fixed capital account method shows only the credit balance. This is because all the adjustments are shown in the current capital account. Whereas in case of the fluctuating capital account method, the capital account may show debit or credit balance. This happens because all the these adjustments are shown in the capital account only. Now let's discuss the format of the capital account under the fixed capital account method. First of all, we write the opening balance by balance brought down. This balance is the opening balance, that is the amount on the 1st April of the financial year. This can be the opening balance, or we can write it as the balance on the closing date of the previous year. So see, that is 31st March 2025 or the balance on 1st April 2025 will be same. It will be known as the previous year balance, that is the closing balance, and this, when it comes to the next year, the previous year closing balance becomes the opening balance. So here we record the opening balance at this place on the credit side of the partner's capital account. Now the addition made during the year will be recorded on the credit side. If there is any permanent nature of withdrawal, that will be shown on the debit side. After this, the closing balance will be calculated at the end of the financial year. Now to find this closing balance, first of all, the credit side, the first and second item will be added, and out of that, the item number 3 on the debit side will be subtracted. The balance between the two will give us the balancing figure known as the closing balance of the capital. This balance is known as the credit balance of the capital because the credit side is greater than the debit side. This item appears in the balance sheet liability side. Now under the fixed capital account method, the two accounts are maintained. First is the capital account and the second one is the current capital account. Let's see the format of the current capital account. Under this also we begin with the opening balance and then all the adjustments like interest on capital, salary, commission, profit and loss account, appropriation account. This is the profit. And these are being recorded because these items are the income to the partner and are recorded on the credit side of the capital account. Now all these adjustments are reducing the capital of the partner or are expense for the partners, that is why being recorded on the debit side. The capital account may show the opening balance on the credit side or it may show on the debit side as the case may be. If there is a positive balance, then it will appear on the credit side, and if there is a negative balance, it will appear on the debit side. And at the end, the closing balance will be calculated. That is to balance carried down or by balance carried down. There can be only one balance for any partner. It can be positive or can be negative. This one is a positive and this one is a negative balance. A partner's capital account can show only one balance. Now let's see the fluctuating capital method account. Under this, we find that if the current capital account and the capital account under the fixed capital account method are merged, then the outcome will be the fluctuating capital account. So here, first of all, we'll be writing the opening balance on the credit side and the additional capital will be recorded here. Then all the adjustments which we have already seen in the current capital account will find its place here. These are the adjustments. These are actually the income of the partner and that's why recorded on the credit side. Now if there is a permanent nature of withdrawal, will be recorded on the debit side because it is reducing the capital of the partner. Now please do watch my previous video to find out the difference between the drawing against the capital and drawing against the profit. Now here on the debit side, we are recording all these items which are reducing the partner's capital account. After writing all these amounts, the last item is to find out the closing capital of the partners. So this closing capital are to be recorded on the balance sheet. If the credit balance comes, that is a positive balance, it will be recorded on the liability side of the balance sheet. Whereas if there comes a negative balance, that will be recorded on the asset side of the balance sheet. And now let's see the connection between the profit and loss appropriation account and the partner's capital account. Now see that the profit and loss appropriation account shows the item on the debit side. These debit side items are the income for the partners and thus these are being recorded on the credit side of partner's capital account. Right? Please see that all these items are to be recorded on the credit side of the partners. Please check the salary of partner A and B, 10,000 and 20,000 recorded here. Then commission of the partner recorded here. For A it is 5,000 and for B it is 2,000. Then interest on capital recorded here, 20,000 for A and 30,000 for B. Next, the profit transfer to the partners, 50,000 each. Right, then the items which are appearing on the credit side of the profit and loss appropriation account, this item will be recorded on the debit side of the partner's capital account because it is reducing the partner's capital. I hope you have understood the connection between the two accounts. This is the income recorded on the credit side of the partner's capital account, and this is an expense for the partner recorded on the debit side of the partner's capital account. With this, tomorrow we'll discuss more questions on the basis of partner's capital account. Please do like and